So, yeah, good evening, everyone. I don't know, is it like but day five for us, officially. Thanks a lot for joining. It mean a lot in terms of your commitment, to study for this exam on a Sunday evening. Um, Thank you so much. So let's get started. We have a bunch of stuff to cover. So primarily, what we will do as promised, right? We will actually revise the ATM, OTM, and ITM concept with the house, that we have seen yesterday. Okay. I'll quickly revise that, but like I think this is a very important concept as well. Right? So primarily, guys, please mute. Thank you. Okay. So what did we say yesterday? I'll just revise a little bit for first 5, 10, 15 minutes. If you feel bored, don't get bored. Because this is a very interesting topic and where a lot of questions do come from, right? And if you are able to get that in your brain, like you are like pakka, right? You will get all the. These are very simple questions only. As I said, right? You just need to understand the concept. So compared to futures, what is the thing what we told about options? Options, going back to my yesterday's example, I wanted to purchase 1 crore of home. Okay. I know I'm talking about crores because I'm sitting in Hyderabad and Hyderabad real estate is crazy, right? So I'm just taking for the hypothetical example of crores. Someone joked I talk about crores, but like who knows, right? We wanted to once we pass the exam, we quickly wanted to get that 1 crore AUM, in SIF, fatafat, right? Anyway, so that's a goal. Anyway, so coming back, right? 1 crore is the price that I want as a buyer. I am interested in purchasing that 1 crore home. Okay. I am going to the seller and then I am saying that, I want to purchase your 1 crore home and then I'm paying the premium, which is equal to 50,000 or 1 lakh. Okay. 50,000 or 1 lakh. This is my premium. Okay. Now, this 1 crore is what? This is my strike price. Always remember that this is my strike price. What do I mean by strike price? Irrespective of the market movement of the house price, I am locking in to buy the house only at once year. Everyone got it? This is a strike price. I'm actually making a deal with you. If you are a seller, I'm making a deal with you saying that, whatever the house that you are looking to sell, I'm going to buy it at 1 crore. Okay? 1 crore and 1 crore only. For that, I'm paying you the token amount, which is the premium there. Now, this is the contract that I'm entering. Option is also a contract, right? At the end of the day, similarly, how futures are a contract, what we have seen with the goldsmith. Okay. Now, please be noted that is strike price. Okay. What is the strike price? 1 CR is the strike price, right? Now, what will happen with the house price? Because it is subjected to vagaries of the market conditions, the price house can actually move either down or can go up, right? Either it can actually go to 98 lakhs, 95 lakhs, 90 lakhs, depending on the conditions of the market, or if there is being there for about 3 weeks, or if there is demand in the market, the price of the house can actually go to say 1.05, 1.1, 1.15, and 1.2 CM. Okay. Now the changing of the house price in the market conditions, that is actually your spot price. Everyone getting it? What is it? The spot price is the change in the house price could be on a daily basis, because in stock market, the stocks keep changing on a daily basis, even like on a minute basis as well, right? What is our tick? Sorry, not the tick, right? The time frame is actually very small. Okay. Now this is the spot price. Now let's understand the scenarios here, right? Now I am locking in 1 crore. मैंने बोला कि right, आपसे 1 crore पे खरीद लूंगा. Okay. But now, okay, 1 crore पे खरीद लूंगा, right? That is the lock-in price that I have done with the seller. Okay. Now, when the spot price keeps changing in the market, now let's come to understand two to three scenarios here, right? What is my first scenario? My first scenario is if the house price has gone to say 1.2 CR. Okay, what is going to happen here? 1.2 CR pay, the house has gone. But what is my option contract, that I have striked with the seller? Whether whatever is the irrespective of the house movement, I'm going to buy only at 1 CR only. Okay. Then in this case, what I will do is I will go and execute my contract. You're getting it, right? I will go and execute my option contract. Okay. What will I go and tell the seller? You know what? I wanted to pay off your 1 crore minus whatever the premium I have paid, like the plus premium, whatever it is. I wanted to take the possession of the house. Okay. I have at what price? At the strike price, which is my 1 crore. Okay. मैंने house खरीद लिया. The house is now here. Okay. Now, when I have executed my contract here, am I in profit or loss? I am in profit. Why? The spot price of the market is 1.2 crore, right? Tomorrow, what I can do is, tomorrow if I got another seller in the market who is ready to buy, right? What can I do? I can actually sell it at 1.2 crore, and then I can actually cash that. I mean, make that balance amount as a profit into my account, right? 1.2 minus 1.1, 20 lakhs. Of course, minus take out your premium that you have paid to the buyer, to the seller, which is, it could be 50,000 or 1 lakh there. Okay. Everyone understood this concept here to start with? One, what happened? My spot price has become 1.2 CR. I have decided to execute the contract. In this case, what actually has happened? I am in the profit, at this point of stage. Okay. Now, what is my second scenario here? Right? Coming back to the strike price remains the same. Guys, remember, strike price remains the same, which is my 1 crore only. What could be the other scenario? The other scenario could be 95 lakhs, right? The house has fallen, could be, the spot price, as of today, in today's market, could be 95 lakhs. Okay. Now, there are actually, ideally, what is the scenario here? As an option contract, buyer, I only have the right. I don't have the obligation to honor this contract. Okay. If it is 95 lakhs, but what is the strike price? I told that, irrespective of whatever is the, movement in the market, I am going to give you 1 crore. That is the promise I made to the seller. Whether I honor the contract or not is on me, because that is the beauty of option, is what is all about, right? If it is 95 lakhs, first things first, I will not even honor the contract. Why will I honor the contract, right? I don't have to honor the contract. I have the right, but not the obligation. Okay, that's the key point in option. I won't honor the contract. What I would say is, you know what? I think, I'm not going to honor the contract because the spot price is 95 lakhs for me, right? If I honor the contract, by paying 1 crore to you, I am going to sit at 5 lakhs loss, 5 lakhs even minus plus whatever the premium that I have paid for you, right? 5 lakh 50,000 is the loss I'm going to incur if I execute the contract as of today. Everyone understood this, right? Clear, right? When I am executing this particular contract, okay, ideally I won't execute. There are two scenarios as I mentioned, right? Scenario one is execute the contract, which means I am in loss, right? What is the loss? My 5 lakhs plus the premium that I have paid. Got it, guys? And what is the scenario two? As per the option contract, I need not even honor the contract. Why? As an option, buyer, I only have the right. I have the right, but no obligation. Everyone clear with these three concepts? Whatever we have discussed this example, everyone clear on this? I will take a quick pause and then
Yes.
if you have any questions, we'll start, we'll go deep. Any cool, everyone got this clear?
Yes, sir. Yes, sir.
Perfect, awesome, lovely, right?
Yes, sir.
Now this is where we will convert that into the strike price in the money, out of the money concept here. Okay. Now let's look into the three scenarios here. What is going to happen. What is now you all understood the strike price, spot price, right? What is my strike price? I'm going to repeat that again one more time. Please bear with me. I will keep repeating some stuff here because I want to get into the like like even if I come and wake you up in the night and ask, right, you should answer the question, right? These questions should not go wrong at any cost. Okay, we will make sure that that's a goal. Okay, strike price is 1 crore. What did we say? Spot price, guys, please put yourself in mute. Thanks. Price keeps changing is what we have mentioned here, right? Now we have seen two scenarios. I will actually add one more scenario. Okay. The first scenario is, the spot price today is also 1 crore. The strike price is also 1 crore for, because that is the promise that I have done for my option seller, right? Now, if I execute this contract, what is the profit that I'm going to make? Guys, please mute yourself. Thanks. Spot price, the profit that I'm going to make is 0. My spot minus strike price. Everyone got it? Now my spot price is 1.2 CR. This is actually called, what did we say yesterday? This is actually called
In the money.
at the money.
At the money. First is at the money. Second is in the money. Yeah.
One second, one step at a time, sir. No. 0 is always at the money. Okay, guys, that's what we discussed. Now, the spot price is 1.2 CR for us, right? About what we have discussed. But what is the strike price? The strike price is only 1 CR for me. Now, what is my spot minus? Now, let's get into this. My spot is greater than strike here, right? 1.2 CR is greater than 1 CR. In this case, when I'm executing the contract, my spot minus strike equals to 20 lakhs profit for me. This is actually called in the month. Everyone clear on this? Everyone clear on this? I want you to be super clear.
Yes.
No second thoughts at all. Okay, super clear, everyone.
Yes.
Spot is always greater than my strike. It is in the money. Got it, guys? Everyone. Okay. If you have any questions, please stop me. More than happy to repeat any number of times. Now, my spot is equals to 95 lakhs here. Okay. My strike is, what is the promise that I have done? My strike is still 1 CR. Okay. First of all, ideally, I don't execute the contract, but in case I'm executing the contract, now let's understand the math equation here. My spot is less than my strike price, right? In case if I'm executing the contract, spot minus strike is equals to minus 5 lakhs for me. This concept is actually called out of the money. Everyone clear on this? Might be, let me bring this here.
So clear. Can you
Sir,
hear me?
one second, sir. One second. Just give me a minute. Let me get this, or maybe let me. Oh, this is let me get. Yeah. Boliye, sir. Tell me.
So in the previous example, the strike rate is 1 crore. Spot is 95 lakhs. In case I am not to honor the contract, what will happen? I will lose the premium.
That's it. You are going to lose the premium. Very good. That's it. You jumped it, sir. You are super smart. That's my next logical. That is my next logical, teaching there. But you got it. Yeah. Everyone clear here, right? At the money, in the money, out of the money. I want you to be super clear, guys. Because without this, there is no exam. Okay. Any questions? Feel free to unmute. Ask. What about the premium? Premium will come to that. Deepak ji, like when you mean by premium, what do you mean by that? Whatever premium in at the money, nothing is going to happen with the premium. Premium all goes to the seller. That's it.
Okay, so in the money and out of the money, we are not taking into picture the premium, right?
No. Don't bring in the premium concept here.
Okay.
Got it. Only we are talking about spot and strikes. Okay. Now, everyone clear? Good. Can we move on? Okay, good. Now coming back to what just now Sara has asked, right? Now we will talk about what is the buyer going to make, what is the seller going to make. Okay. Now there are two options here, right? What is going to happen? There are two scenarios. Okay. This is something called the okay. Now I as a buyer, I am interested in actually buying the house. Okay. I'm anticipating the house price will go and I'm actually going and buying the house. Okay. I am taking a long position in the market, in the housing market, right? I am actually called a buyer. Okay. Sometimes what happens is, not sometimes, this is the usual scenario as well. The seller, the house, if say suppose I'm owning the house, right? I also will, strike a contract, saying that I want to sell the house. Okay. Because why? I could have a number of different needs and I want to sell the house and they want to might be do some investments or whatever. I have a couple of other needs, right? Okay. There is a seller also, right? It is need not be that the buyer always have to initiate the contract there. The seller also initiates the contract. Got it? When the seller is initiating the contract, it is generally called as put. This is call. Okay. We will see these two scenarios. Long में क्या होता है, short में क्या होता है, who actually benefits in this both scenarios, because this is again a very interesting concept, very popular question that these guys will ask. Now first we have already understood, right? In the case of the buyer, right, in yesterday we discussed that, but we will repeat that one more time. Okay. Let's go through this carefully, not carefully, right? You guys are already know this. Now let's go through this finally here, right? Now what is happening in the buyer side? First of all, right? What is happening in the buyer side? What is buyer doing? First of all, he's paying premium, right? He's paying premium and then he's locking in the contract. He or she, right? With due respect to all the other genders as well, he or she is locking in the contract. Is that not? Everyone got it? Okay. Now, what we have seen in these two scenarios here, when the two scenarios is when the spot price has gone to 1.2 CR. Okay, what is he going to make? The profit. Okay. In this instance, when the buyer is executing the contract, what is the profit potential here? What is the profit potential here?
19 lakhs.
No, that's fine.
For buyers?
Unlimited.
Very good. Someone said that. The buyer has unlimited potential for profit, right? So for example, what happens? So imagine that tomorrow government comes and says we won't even know, right? So if say tomorrow government comes and says, what, I'm actually creating a ORR next to that, okay? Or maybe I'm creating I'm giving an industrial park, very next to that area there, right? Who knows, right? Today the 1 crore could actually jack up to 3 crores tomorrow. I'm just taking a hypothetical example. There are a couple of instances that have even happened, right? In India. Okay. So in that case, what is going to happen, right? If that in 1 crore strike price, the spot price, if it becomes 3 crores, the buyer has an unlimited potential profit. Yes or no, guys? Everyone agree, right? Unlimited potential profit is what the buyer can make. Now, in case if it decides, if the spot price has come down to 95 lakhs as we have seen before, in case if it decides not to honor the contract, in this case, he's not honoring the contract, he's not letting go. He's letting go of the contract. He's letting the option expire. He's not even honoring the contract. What is the potential loss here in the case of the buyer?
Limited.
Premium money.
Very good. This is very, very famous question, right? Very famous question, for NASM, SIF exam. The loss is only limited to premium only. Okay, please take a note of that. Very, very important. In the case of the buyer, the profit is unlimited. In the case and the loss is limited to premium only. Okay. Now let's take an instance of the seller. Okay, I will take a quick hypothetical example here. Okay. We haven't spoken about the seller side. We will talk a little bit on the seller side. and we will derive the what I mean to say, the profit and the loss potential for the seller. Okay, so the same thing, right? What is the seller going to say? Seller is going to say that, like, 1 crore, I'm going to sell the property at 1 crore. Okay, and what he will do is he will go to a buyer, like for example, he is coming to us and he is actually taking a certain premium. Okay, he is taking a certain premium. In this case, what is the strike price? The strike price is still 1 crore only. Okay, now let's see couple of scenarios here, right? First let's see, for example, going back to our previous example of, I told might be ORR is coming, some industrial stuff is something is coming, right? So all of a sudden, the price of 1 crore has become 3 crores. Just hypothetical example, right? What is going to happen in this scenario? What is going to happen in this scenario?
Profit is premium, sir.
He lost his
He
premium.
has to give the property and he will have an unlimited loss.
Very good, right? So what is going to happen in this scenario is buyer will come immediately and he will execute the contract. Why? That's what, right? Seller has said, I am going to sell the property at 1 crore and he has taken the premium. Buyer will be like, Ari, ये property बढ़ गया था, right? 3 crore हो गया अभी. So what will he do? He will come and execute the contract immediately. At what price? At the strike price of only 1 crore. Okay. So the loss, sorry guys, the loss for seller is unlimited. Everyone getting it? The loss for seller is unlimited. This is very, very important question. Okay. We are doing with examples, we are doing with this. I'm happy to repeat a number of times, but you should not get these questions wrong at any cost. Okay. Okay. If that is the case, it's a lot of our time. Yeah,
is this seller's is this the seller's obligation, or he can go back and he can pay back the premium?
No, seller has the
he
obligation.
he cannot.
Okay.
Because in the case of the contract, seller can never actually, seller always have the obligation to sell. Seller doesn't have the right. Okay, please remember, that's a very good question, sir. Seller never has the right to deny it. Okay, buyer has the right but no obligation. But in case if you are a seller, if I'm a seller, if I'm going to the buyer and I have decided I'm going to sell it at 1 crore, the strike price there, whatever is the instance, I have to, if the buyer is coming and saying, I want to honor the contract, I want to execute the contract, as a seller, I have to honor the contract. Kuch bhi hoga, whatever might happen, right? I am obliged to honor the contract. I don't have the right, to say no. You're getting it? That's a very key important factor between a buyer and a seller. Very good question. Everyone clear on that?
Yes, sir.
Okay.
Yes. Thank you.
Okay. Now let's move on, right? Now let's move on. Now let's say what is happening here. 1 crore ho gaya. Now the house value has come down to 95 lakhs, right? Now what is going to happen in this instance? What is going to happen in this instance?
So buyer will not go to execute the contract.
Very good, lovely. Yes.
And the seller will lose his 1 lakh premium.
No. Why will he lose?
No, he'll get.
Buyer will lose.
Yeah, he'll get that.
Lose the premium.
Very good. Just hold on. You got it correct. 95 lakhs. In this instance, what is going to happen? The buyer will say, I'm not honoring the contract, because it is less than the strike price for me. And he will move out of the contract, let the contract expire. In this case, the profit that, the seller will make is only the premium that he has received. Guys, everyone got it? What is the premium that he has received? That 1 lakh only. Okay, everyone clear on this? Everyone clear on this? Questions? Hello?
Yes.
Perfect. Lovely. Nice. Now let's switch this, and then I wanted to just show it here. We put it in this. By the way, I was not able to share the PPT because I want to complete the chapter. And as soon as the class is done, I'll upload that into the Notion. You can actually check this out.
Low network, I'm not able to get it.
Sorry?
Just repeat the last one because I could not able to get
This one?
That's because of some network issue.
No. What I'm saying is, so for example, what
Yeah,
happens
yeah.
with
95 lakhs.
95 lakhs, what is going to happen? The buyer will say, I am not going to oblige the contract, and he
Execute the
will move
contract,
on.
then.
He will not execute it, right? So
Yeah.
what is the profit that the seller is going to make? Only the premium that he has
Premium what
received
he got
initially.
from the buyer.
That's it. Okay.
That's it. Yeah.
Let me also use this word here, limited. Okay. The profit is limited, but the
Okay.
loss is
That is
unlimited.
unlimited. Got it. Okay.
Got it. Okay. Let's quickly do the quick thing here. Okay, let me put it in full screen mode. Okay, this one. This we just now did this one, right? Buyer, what is the risk? He is risking only the premium paid. The return is unlimited. In the case of the short thing, in the case of the seller, what is going to happen? The risk is unlimited. Because risk matlab, here it is the loss here. Might be, I will show you another one. Return is limited only to the premium received. Okay, guys. Call option, put option, right to sell. Moneyness, I think we should be super clear on this. Now I have put the numbers here as well. Please revise that if you want. I'll come to the premium in a bit.
Kiran, in moneyness, the premium thing does not apply.
Moneyness for now, we're trying to keep it simple. Don't worry about the premium. Only the premium comes into the picture when you execute the contract. But why do you want to complicate that? Adding premium to that.
No, I just wanted to ask. That's it.
Okay. Now, okay, you can go through this, primarily. Now, a little bit on the stuff, right? Everyone clear on those concepts? Long, short, at the money, in the money, out of the money. That is what options chapter is all about, which is the most important chapter, See, if you pick up the NSM and NISM book, he will talk about so many graphs and so many tables, etc. and all, don't get bothered about all that stuff, right? We will do all that examples, and that is like you will go super crazy, when you start reading that. Don't do that. Okay, just focus on this part here. Okay. Now, quickly we'll do couple of what I mean to say, the stuff which are quite easy here. Okay, there are two types of options. This is again a very favorite question for NISM. We will talk a little bit theory, for a moment. There is something called as an American option. There is, other one is called an European option. Okay, what is an American option? First, let's come to the European option. European option says you can execute that contract only on the expiry date itself. Okay. What is the expiry days for India? In the case of the indices we have discussed, that NSE it is Tuesday, BSE it is Thursday. The options get expired. The value becomes zero. Either you execute it or don't execute it. That option is available only on Tuesday and Thursday, which is on the expiry days itself. Okay, that is called a European option. Whereas the American option, which is very quite popular, is in the US option. That is why there is so much of liquidity in the US market. Okay, you can actually exercise the option any day. Don't get in the technicalities. Just remember this. Okay, European option, the option expiry happens on the expiry date. American option, the expiry can happen every day. Okay, or any day. Okay. India actually follows European option model. Okay, that's what we discussed. NSE on Tuesday, BSE on Thursday. Clear, guys, everyone? This is a very simple question that he asks, and the one tricky part, what he will try to do is, he will try to talk about European option may, right to call, obligation, and all that stuff. We will do those questions, don't worry. But the concept is very clear. Okay, questions on this quickly? Good. Perfect.
So you mean American options gets the everyday settlement? Is that meaning?
That's correct. Yes. Because of the liquidity, they have decent liquidity in the market.
Okay.
Sir, in that case, sir, what is the purpose of expiry in the American option? Because if it is every day, then every day is an expiry. Then that is.
No. Every day, what is happening is the options are being written and closed, on a day-to-day basis there. You getting my point? So imagine like this, sir. What is happening here? Let's go back to quickly our house example, right? I'm going to the seller. I'm saying, I'm getting into the contract, but I'm actually setting a date, for that, seller, right? For example, right now I'm going to do that only on 15th of, let's say 15th of next month only, right? Now, what is going to happen? In the case of European option, as per what is happening, even if there is a change in option, whatever the criteria, multiple stuff that is happening, I can execute that contract only on that particular day, on 15th only. I can't execute beforehand. But whereas, for example, if today, like, there is 1.5 CR, 1.6 CR, 2 CR, 3 CR, etc., and all that is happening, I can execute in the case of the American option, I can execute that contract. That is what the beauty of the American market is. Okay. First things first, don't get too much of technicalities. We are not here studying that. Just remember for the exam purpose, European option, expires on the expiry day itself. American option can expire on any day. Okay, that's more than sufficient for you at this point of time. Clear, sir? Abdul, sir.
Okay, sir. Thank you, sir.
You can revise all this stuff. Similar to what we have discussed. It is just that long option, short option, buyer, holder. It's all the one and the same thing. It's not like much of a difference. That is out there. Okay. Okay. We covered this. Okay. Now, what is the premium, right? That is the most important thing. And there are a couple of formulas that you have to remember for this exam. This is one of the formulas that you have to remember, because he will directly give you time value, he will give you premium, he will ask you to calculate intrinsic value, he will give you IB and TB, and then he will ask you to, calculate premium from the exam perspective. Okay. But let's sort of understand a little bit of the concept. Again, we will not go too deep into the concepts, right? So what does intrinsic value mean, right? If you see here, on the screen, if you exercise the contract today, in like what would you pocket in your hand, is actually the intrinsic value of that particular contract. Okay. So let's do this, right? Let's go back to our example. 1 crore ka strike price hai, 1.2 is my spot price. I am executing the contract. Okay. What is my intrinsic value there?
1.2.
1 crore. 1 crore.
Go through the
20 lakhs.
Okay, so very good. Someone said 20. 20, it's not actually 20. One more answer.
19 lakhs.
Very good. Whoever said that, right? Vijay sir. All right. What does intrinsic value mean? Intrinsic value means if I'm executing the contract today and if I'm making profit, what is the profit I'm making minus my premium paid is what intrinsic value is all about. Got it? That's the concept. Only understand, Vahita. Okay, don't go too deep into analysis. Okay. Again, as I said, we are not writing analysis the PhD securities exam. So this is only to clear the SIF exam. Okay. Everyone clear on that? Intrinsic value.
So intrinsic value is a profit what we are making it.
Correct.
Clear understanding?
Exactly.
Okay.
Correct. Minus.
It's only the cash flow, sir, because he is only making a profit. The other things are as it is. Only the cash flow, you can say.
Yeah. Yes. Okay. Now I want. This is a very interesting question. Which the exam likes, right? tell me, from whatever we have discussed, right? At the money, in the money, out of the money, where, how does the intrinsic value behave, at the money, in the money, and out of the money? Which one is positive, which one is negative, which one is zero?
In the money is positive.
In the money is negative, positive.
Right? Next.
At the money is zero.
At the money is zero, and out
negative.
of the money is negative.
Very good, right? So intrinsic value is always positive in the money, and at the money and out of the money, we don't even consider. Okay, this is again a very, very favorite question. Intrinsic value is positive only for in the money options. Okay, that's again a very, very famous question for the exam. I think now you're able to understand from the concept perspective. Yes. Okay. Now, let's come to the time value thing, right? The time value thing is a little tricky, it's not even a tricky concept. I will take one example here, right? So for example, like, I am buying, lottery tickets. Okay. Lottery tickets, if I'm buying, there are two expiries for lottery tickets. Okay. For example, there is a lottery ticket which is expiring, tomorrow or day after tomorrow for me. And there is a lottery ticket which is expiring for me, might be 3 months down the line. Got it, guys? There is a lottery ticket which is expiring for me in the next 2 days. There is a lottery ticket which is expiring for me in the 3 months. Okay. In this instance, what is the value that I'm ascribing to ticket 1 vis-a-vis what is the value that I'm ascribing to ticket 2? Tell me. You got the concept, right? I mean, you got the situation, right?
Can you repeat? Can you repeat?
I am buying 2 lottery tickets.
Lottery ticket.
Okay.
Yeah.
One lottery ticket, lottery nikalta hai, right? The results. The first lottery ticket, the results are in next 2 days from. Got it. There is another lottery ticket, where the results will come or which will get expired or whatever the terminology in the next 2 months or 3 months. Okay. I want to ascribe the value for ticket 1 and I want to ascribe the value for ticket 2. Okay. How will I do that? What is the value that I will ascribe to ticket 1? What is the value that I will ascribe to ticket 2?
The ticket 1 value would be very small.
One value.
One at a time, guys. One at a time. Raju sir, go ahead.
Yeah, ticket value for expiring within 2 days is very less.
Sir, there is so much of noise. Okay, one more. Go ahead.
Ticket value of the lottery that is expiring tomorrow will be more than the ticket value of lottery that will expire 3 months down the line.
Okay, one more option.
Ticket value which is expiring 2 days after is having less as compared to ticket value which is expiring 3 months later more. Reason why? Because 2 days after 2 days we know that the chances of the premium going to up and down, the value of the strike value or the spot value, it's not the strike, sorry, spot value will be chances to come at that there's a lesser than that 3 months later.
Absolutely, bingo, right? So in this instance, the time value, the ticket value for my 3 month is little higher actually than the time value, the ticket value for my 2 months. I'm sorry, that is expiring in 2 days. Because why? Like, see, for example, right, now let's take this quick example, right? There are say 1 lakh people participating in the lottery. Okay. There might have been, already 99,500 of people who bought the lottery tickets. I am in the remaining 500 and I am buying the lottery ticket which is getting expired in next 2 days. What is my probable chance of getting and winning the lottery? It's highly, unlikely. The probable chances are minimal there. Okay. Of course, let's talk from the math perspective. Let's not talk from the luck perspective, right? But whereas the three month, what is going to happen, right? When I'm buying now, right? There is higher probability that my number can get picked up. Again, talking from the probability perspective and math perspective, right? Okay. So my value of my ticket 3 months down the lane is, little higher than the value which is getting the ticket which is getting expired in 2 days. Okay. That concept is actually called time value here. Okay. Now, what is going to, I will introduce this concept of time decay here itself also. Now, everyone clear, right? Of course, people wanted to debate that, on this. We can debate for the whole night, but for now, at least on the basic probability thing, you're getting it right.
So got it, sir. Lesser, longer the time frame, longer would be the time value. Lesser
Exactly.
time frame, lesser would be the time value.
Right. Now, similar to what actually happened with the shorter time frame, where the value has become less. Now, when I start reaching out, now today is July, right? So for example, my ticket is getting expired in the month of September. Okay. Now, as it progresses, along the time frame, what is going to happen if someone is buying the ticket, then the ticket value also will come down there. Okay, because why? It is actually coming closer to the expiry. The process of where my ticket price is here and where my price slowly starts coming down is actually called the time decay. I will show you example very quick just in a bit. But just to close the loop here, right? Premium equals to intrinsic value plus time value. Intrinsic value is, right, if I execute the contract, what is the value that I'm pocketing minus the premium? Time value is it's out of a hypothetical thing where I'm ascribing a value to that particular contract based on the time factor that is involved there. Clear everyone on this? Cool. Any questions? Okay. Let me quickly switch gears here, right? I wanted to show you, this part. What is that time value here, right? Now, let's look into 23,000 put. I have taken the Nifty index here, right? What is today? 12th. Okay. This is similar to our lottery ticket example here, right? 14th July, 23,000 put I have taken. What is the value there? 2.45. Got it? What I have done is, second month ka, August second week ka expiry ka put मैंने लिया था. Again, same strike price. 23,400 put for 11th June, 11th August. What is my value there? 123.45. You can see that, right, guys? Here, this one. Everyone observing it, right? Now, I am going to the third month. September ko ja raha hu, right? Same, you can call or put or whatever stuff, right? I'm taking call. But what is the value of 23,400? It might be, let's see, for the purposes, we will actually add call itself so that you're all happy. Nifty, what we will do, 23,400 September put. Because we are talking about put. Sorry, I did fin Nifty, my bad, sorry. Nifty 23,400 September put. This is what I have got. So, what is the price here? What is the price here? 193. Got it, guys? So what actually happens is when the 29th September put is about to expire, right? That 193 will slowly start coming down and down. If you are seeing here, right? The expiry, when is the expiry for us? Tuesday is our expiry. The 23,000 put is what is happening? 2.45. What is going to happen on the expiry day? It will become zero. Okay. Don't worry about this option strategies, etc. And all. Once you clear the exam, for distributors, we run separate programs on understanding the strategies for you to talk intelligently to the investors. Okay. We will do exclusive detailed sessions on strategies there. But for now, the point I'm trying to allude to, and especially for the exam perspective here, is the concept of time decay. Okay. Time decay is what, as the time progresses, the option value, comes down and actually becomes zero. Got it, guys? Everyone clear on this? Any questions?
Yes, I got it.
Perfect. Let's move on. Okay. Now we have studied intrinsic value. Intrinsic value is always positive or in the money, and like OTM and ATM, there is no intrinsic value out there. Okay. Just now we have studied time to expiration. This is the whole concept of time decay concept. This is what I have just now showed you in live as well. Day after tomorrow expiry 2.45. I want you to actually track it. It will 100% absolutely will become zero. Okay. Don't worry, we will do option strategies and all at a later stage. But the time decay is what the option goes through. Okay. Sometimes people got options on wasting assets because at the end of the expiry, they actually become zero. Okay. That's not a question that NISM will ask, but okay. Let's move on. We have done this. You can revise that at your end. Okay. So there is this concept of again, we won't go too deep into these concepts. I'm telling you. We will study only from the exam perspective. Okay, because in fact, like we are developing some sort of high frequency strategies, etc., and all for the Indian market, and we deeply go deep into this delta, gamma, theta, vega, and rho, and to analyze how the options are moving, etc., and all. Okay, if we start going too deep into the concepts, like we have to study for so long, right? But I will quickly. This is like, for example, right? From the exam perspective, we will study. There is something called rata mark sometimes, right? You have to remember certain stuff, and this is one stuff. Okay, and I will also tell you how to remember that. Right now, the first one is what is called delta. Okay, what is delta? Now I have the stock price, right? Reliance, for example, my price is 1307 today or 1310. If Reliance is moving from 1307 to 1310 and 1315 and 1320, how much is my option price move? Okay, for example, right, at 1307, my option price is 36 rupees. Okay, when 1307 to 1310 to 1340, 1315 is my how is my option moving? Like, is it moving from 37 to 40? Is it moving from 40 to 45? Or is it moving from 40 to 42 or 41? 37 to 38, 39, etc. and all. When is what the correlation is actually called delta. Okay, the price in the change of the option with respect to the price of the particular stock, the actual price of the stock is called delta. Clear everyone on this? Only remember until then. Don't complicate yourself. Okay, what is happening now? Clear everyone on this?
Can you put some example on this?
Okay. So, for example, let's go back to our broker thing, right? Okay. What is this one? What is this one actually? So, for example, Reliance spot price is 1307, sir. Right? Now, what is my July 1300 call? What is the price here? 33.70. Right? Now, if the price has moved from 1307 to 1315, what is the expectation here of my 1300 call that is on the screen? Tell me, what can it become?
You become more than 37 or something like that.
Right. How much it can become? Sir, whoever has asked it, sorry, I couldn't track the name.
It should become more than 33.7. Should be
exactly
40.
Right. That's it. Right. What is delta? The delta is what is the change in my option price movement when my the stock price moves. That is what is called delta. Got it? Whether the 33 becomes 35, 36, etc. and all, when the price moves from 1307 to 1310, 1311, 1312 is what my definition of delta is all about. Okay, clear? Only remember until then. Clear, guys? Everyone?
The price move in positive side, it will call delta.
Sorry?
Spread moving
Anywhere, price can
okay.
go negative also, right? Whatever it is.
Okay.
See, the option can also go negative, no, sir. Option need not be positive. See, this 33.70 can even become 27, 28 also. I am least concerned about the direction. I am concerned about relative to the price. What is my option movement? No, that is what I am concerned about. Okay, cool, perfect. Okay, let's
Sir,
switch
is there
gears.
any fixed percentage that it will move, sir? For example, in this case, just go back to the slide.
It won't. That's what I'm saying. The capture of the percentage movement between my the stock price to the option price. That is what is called as delta. There is no fixed one. That.
No, for example, here, so 1307. So it is mentioned as 33 and odd, right? 33.7. So for a simple thing, if it moves to 1310 instead of 1307, 1310 in this case, so how much would be this 33.7 would be?
No one knows.
Okay.
No one knows, because it
Okay,
is dependent on multiple factors, right? That can actually become, 34.10, 34.40. See, there is always no linear relationship.
But definitely there will be a positive movement,
Exactly.
increasing movement. Okay.
Correct.
Okay.
There is
Okay.
no
Okay.
linear relationship primarily,
Okay.
right? That means if it is moving 1%, there is no guarantee that my option price will move 1%. Okay. Now, what delta, that is where delta is coming to the picture. What delta is trying to do there is, when this price is moving from 1307 to 1310, how much is my 33.70 to X number is happening. Okay. So that relative movement is getting captured by the delta. I think
Okay,
now
sir.
you should be clear. Okay.
Yes, sir.
Perfect.
Very much, sir. Thank you. Thank you, sir.
Perfect. Awesome. Okay, guys, we need to finish this. Let's quickly move on. It's very easy on me. Now you can read through this. I have given the little bit of a deeper analysis if you want to. As I said, soon after the class I'll upload this PDF, convert it to PDF and upload that. Okay. Now what is gamma? Gamma, generally most of the times people don't ask about gamma. Theta, vega, rho are the most popular questions. Gamma is right. Changing gamma actually captures changing delta. Okay, only remember that. Okay, so what does gamma do? Gamma actually captures changing delta. Delta captures how much of the option price is moving with respect to the stock price. Gamma captures how much of the delta is moving when the stock is moving. Okay, now what is theta? Theta is what is the option price, how much of the option value it is losing as the time is passing. We just now spoke about time decay, right? In September it is 193. Day after tomorrow our expiry is 2.45, right? What is the option value change in terms of how much value the option is losing by each day is being captured by theta. Okay, just only remember until then. Okay, now I'll give you a little trick here. Okay, how to remember this? T for T. Okay, they will use time decay in the exam. Theta is always related to time decay. Okay, please, these three questions are very, very important. Theta, vega, and rho. And again, 100% there will be a question there. Okay. You need not remember the concept as well. I'm giving you some blind exam ka jugaad here. Theta stands for time decay. Okay, how the option is moving, from top to bottom. Okay, as the time progresses. Okay. Now, option price is also dependent on vega. Okay, what is vega? Market volatility. What is market volatility? Who would have thought on Friday that again Trump and Iran will go into the war and Iran will actually close Strait of Hormuz over the weekend? No one knows, right? That is actually market volatility. Okay, what is vega? V for V. Vega stands for change in the option price with regards to market volatility. Just remember this. Theta is what? Theta is option price change with regards to the time, which is time decay. V stands for volatility, which is your market volatility. Okay. What is rho? Okay. Rho is, sometimes there is change in interest rate moves. Of course, like we'll not get into the details there here, but for now, there is change in interest rate movements. The option price also is actually gets affected. Okay, so only remember that point, right? So rho stands for R, right? Risk-free interest rate. Okay, you're getting my point, right? Theta stands for time decay, vega is market volatility, rho is interest rate, IR or whatever you could, do that. Okay. So these are called option Greeks. Whatever the option, number that I have shown you, right? That 133 just now, it is little complex. It just doesn't come just like that. It is dependent on multiple factors. And the interesting part is neither the exchange nor the brokers actually set the option prices. Okay. So there are multiple factors that goes into it, and the option Greeks is one of the very famous concepts, and these are the delta, gamma, theta, vega, and rho are the ones that you have to study. Okay, this is very important. Any questions on this? Any questions?
Kiran, they will only ask about the theory or like
only theory. It's all one-liners, true or false. Sometimes what it will say is, oh, vega is actually change in the risk-free interest rate, true or false. Okay, the answer is false. Vega is changing, time decay, price, the again answer is false. Vega is actually changing the market volatility, the answer is true. Okay, it's mostly the direct, simple one-line answers. Either you have the filling choice A, B, C, D, or it's either true or false questions. You won't get beyond that. I will promise you there. Okay, it's not like that. It becomes super complicated, and you know what that means. Okay, cool. Any questions, guys? This actually completes the options chapter for us. I have covered almost everything. Okay, there are two things. I think there is option pricing models, which is called binomial pricing model and Black and Scholes model. Just remember that there is lot of formulas, etc., that you will see in the NISM workbook. Okay, don't too much bother about that. Okay, and whatever is the calculations, etc., and all that, again, don't bother. Whatever these, how many slides? 19-20 slides. That is more than sufficient for you. Okay, let's quickly do one thing. NISM loves the questions after the chapter. Okay, what we will do is based on our you will actually see the answers there, but what we will try to do is we will try to attempt these questions from whatever we have done just now. Just give me a second. Sorry.
No.
Before that, any questions, guys? Anyone? Okay. Now let's go through this, right? Okay. Okay. The buyer of an option cannot lose more than the option premium paid. First of all, is it yes or no? Sir, Ashish sir, let's complete this question and we'll come to your question.
Sure, yes.
Yes, sir.
The buyer of an option cannot lose more than the option premium paid. That's what you told, right?
True for C.
Right? So here, guys, oh God, please kindly. Okay. So here, generally what he will try to do is, he will try to, trick you saying that we studied European options and American options, right? American options is expiry can happen every day. European options, the option contract can expire only on a particular dates. So it is actually true for all the options. This is like little tricky thing. We will do, what I will do is might be once we cover all the course topics, etc. and all, we will sit one weekend, Saturday and Sunday mornings and evening, and we will do all the 1500 questions. The next day you actually pick up the date, Monday, Tuesday, you go to exam and you clear that. Because the moment it is fresh, you have to clear it. We'll work on that. Don't worry. Okay. Now, you sold a put option on a share. The strike price was 245 and received a premium of 49 from the option buyer. Okay. So what is the loss that is available on this position? Okay. Now, this is not tricky. Here, what is he trying to say? He is actually talking about selling a put option, which is actually equivalent to buying a sort of buying the call option here. Okay, don't worry on this. We'll do that. Anyone want to attempt that?
49.
It's 196, 245 minus 49.
196. No, that's the answer here. See, don't worry. We will do this again.
Yes.
We'll do that again. Don't worry, guys. Okay. Here, current price of the stock is 286. What is the intrinsic value? Very easy. What did we say is the intrinsic value? We discussed this in the last intrinsic value. We discussed today only. What is intrinsic value?
Profit.
No. Intrinsic value is this one.
It's the profit what you are making it, right?
No. Intrinsic value is the profit, right? Sorry, my bad. Yeah. What is the profit? Here.
26.
Strike price minus the current price minus strike price.
19.
Why is it now 19? You don't consider 45. No. You should not.
It's 286 minus
260. That's it. 26. Okay. Here, he says European call option gives the buyer the right, but not the obligation to buy from the seller and underlying whatever the stuff. Is it true or false?
False.
It is false, right? Whatever is the option, whether it is an European option or an American option, it gives the buyer the right and not the, I get the right. Oh, no. Okay. Here there are two tricky things here, right? It gives the right and not the obligation. But what is he trying to ask here? European call option. He's saying before on or before the expiry date. Can it happen?
No.
It can happen only in American call option.
Expiry date it happens.
It happens only in expiry date. That's why it is false.
It's false.
Okay. So what I'm trying to, why I'm actually showing these questions is whatever the topics that we have discussed, that 19, 20, 21 slides, the whole concepts and topics are that only, right? It is just that you integrate and here they make it little tricky sort of stuff. Okay. For that, you require little practice, and as I said, I promise you that we will do questions for that. Okay. So in the money option, we discussed this is very straightforward. In the money option, what happens with the intrinsic value of the in the money option?
It's positive. In the money option is positive.
Positive. That's it. Bingo. Right? Yeah. Ashish sir, go ahead with your question and we'll wrap up the session.
Yes, sir. My simple question is that whatever we have learned in options, this all implement in currency, equity, and the third one is interest.
No. It won't. Currency will have more of appreciation and depreciation. We will discuss the topic. Unfortunately, the options are not actually the same. I mean, in the sense that the concepts are the same. You have the ITM, ATM, OTM, etc., and all that. That is spread across the same thing. But in currency, we have to study appreciation and depreciation. Okay. What I will try to do is we will try to cover that topic, might be possible from tomorrow and day after. Okay. Because I want to first understand that concept, in the case of whatever the currency appreciation and depreciation, similar to what we have done with the house example for options. I will pick up one example. Okay. You will be super confident that once we do that, right, there are a lot of, examples that we have to do there. Okay. For example, this exam becomes little tricky. People say because of currency derivatives, because he will talk about I'm a textile manufacturer. I have exposure to this currency. How will I hedge my currency? Okay. I'm a textile exporter, right? I'm anticipating my currency will depreciate, or the other currency will appreciate. How will I hedge it? Okay. So those are the questions that are very, what I mean to say that I won't call it even as a case studies, but little, questions there. For that, we have to understand the concept of appreciation and depreciation, similar to what we have done with ITM, OTM, and ATM. I will take one, come up with a decent example, or like we will see a couple of practical stuff, and you will understand that. On the top of it, we will do case studies. Okay, I am giving you a long answer, but these concepts of option price, strike price, ATM, ITM, OTM, these are all same across currency and interest rate. Okay, got it.
Well noted. Well noted.
Perfect.
Sir,
Any
tomorrow
other
what
questions,
time class,
guys?
sir?
Same.
Tomorrow what time?
Tomorrow will be 8. Yeah, tomorrow will be 8 because it's Monday.
Okay, thank you, sir.
Or do you want to do class tomorrow? I know it's Monday blues. I think let's do that now. Or what do you guys say?